Welcome to the deep dive. Today we're jumping straight into a big one. Artificial intelligence versus the expert human financial advisor.
The robo-advisors against the traditional approach.
Exactly. Our mission here is to really cut through all the noise, look past just the low fees, and figure out where the real value is.
Where it actually lies for your portfolio in the long run.
Okay, so let's start with a really, a pretty jarring metric I found in the source material.
Okay, let's hear it.
So, clients believe a human advisor adds about, what, $160,000 in value to $1 million goal.
Right, which makes sense in terms of perceived value.
But, and get this, if they achieve the exact same goal using robo-advice, they only attribute about $50,000 of the value to the algorithm.
Wow, and that creates this immediate cost paradox, doesn't it?
What do you mean by that?
Well, the costs are inverted. The robo-advisors, they're cheap. We're talking 0.25%, maybe 0.50% of assets under management.
While human advisors are closer to 1%, sometimes more.
Exactly. Yet the data shows that clients who use human advisors can see, sometimes double the net dollar value over a lifetime.
So that higher cost is actually, it turns into a net positive.
It often does, yeah, because the human prevents much larger, much more costly mistakes.
Okay, but let's be fair. AI has an undeniable quantitative edge, doesn't it? I mean, no human can process that much data that quickly.
Oh, absolutely not. The AI models can hit something like a 60% accuracy rate in earnings predictions.
Which is just slightly better than the best human analysts.
It is. They peak around 57%. But the source of that outperformance is where it gets really interesting.
Go on.
Simulations show an AI analyst can outperform human fund managers by an average of 600%.
600. Okay, how? Is it just better at picking stocks?
Not really. It all boils down to emotional discipline. The key metric is portfolio turnover.
Right, the amount of buying and selling.
Exactly. Human-managed funds average around 72% turnover annually. They're constantly reacting, chasing trends, which just eats into returns with fees and taxes.
The AI.
It just sticks to the plan. It averages only 31% turnover. It provides that perfect rationality.
But that perfect rationality has to be its biggest weakness, too.
It is. That's its fatal flaw. It's total reliance on historical data.
So if something happens that's never happened before...
A black swan event, right. A truly unprecedented crisis. The algorithm has no intuition. It just can't adapt.
And that leads to this bigger systemic risk, this idea of algorithmic herding.
It's a huge risk. If everyone starts using similar AI models, they might all react the same way in a crisis, which could make the next financial crash much, much worse.
So if the machine is for data, then the human advisor earns that higher fee by managing the biggest variable of all, the client.
That's the core of it. The greatest detriment to your returns isn't the market. It's usually your own behavior.
Panic selling during a downturn, getting greedy at the top.
All of it. The human provides that behavioral coaching to stop the client from making a catastrophic error.
And you can see that reflected in the client satisfaction data.
It's an 84% satisfaction rate for clients with a human advisor.
Versus only 77% for the purely digital services.
And here's the critical part. 88% of those digital clients said they would consider switching to a human. That points to a lack of long-term trust.
There's that emotional metric, too. Investors report feeling 3 times as much peace of mind with a human advisor compared to doing it all alone.
It's a buffer, an emotional backstop. That confirms the future isn't one or the other. It's a hybrid model.
The advisor in the loop.
Right. You use AI for what it's best at. Efficiency, data analytics, scenario modeling.
Which frees up the human expert to provide the tailored, empathetic advice during complex life events.
We're talking about things like intricate estate planning, managing a large inheritance, or figuring out bespoke tax issues.
Things where context and judgment are everything.
Precisely. So AI becomes this great equalizer for beginners and the mass market. It provides that low-cost access.
But as soon as life gets complicated, you need a human.
That's the takeaway. So the question for you to think about is this. When life throws you that major financial curveball, a market crash, a family illness, a sudden inheritance, what price would you put on the emotional peace of mind that an algorithm simply cannot provide?